Love what I do, and I love people who invest in properties intelligently. I love to see people make money, and that's why I'm here. If you can glean just a little bit from this event this evening, and it helps you to be more profitable and more successful, then I'm going to be a happy woman. This week, a lot of people keep asking me, Kathy, are the rates going up because the Fed is raising rates? So I put on your front page, I put on your front page an explanation that really explains that when the Fed raises the prime rate, it really affects more the adjustable rate mortgages and credit card balances, your car note, things like that, but not as much as your 30-year mortgage rate. Those are based upon bonds, and there's a lot going on. If you get up and you watch Squawk Box or CNN or one of the morning news programs, all the pundits are perplexed. You don't quite understand what's going on. So if you think I'm going to compete with some of these top financial guys on television and try to tell you why this is happening, you got another thing coming. You never quite know. What we do understand is that rates have gone up about 3/4 of a point in the last 2 weeks, and they will probably go up another 3/4 of a point by the end of the year. Hi, welcome. You are?
James Wallace.
Oh, God.
Thank you. Fine.
Grab a chair. Grab a chair.
Sorry.
We've never actually met, but James is one of my better customers. This is a real honor to have him here. Okay. So as I mentioned, we're a direct lender. We are one of the top 5 lenders of renovation and remodeling loans. We also do VA loans very well. We do USDA loans very well. We have VA automatic underwriting authority. And I've only had a half a glass of wine. It's these heels. I'm not used to heels, folks. So what we do very well. I've been with a few lenders in my career. I'm not a young girl anymore.
Yes, you are.
Thank you. I love this woman. So I've been with a few lenders, and when I learned about Michigan Mutual, it's because they do what I love better than anyone else in the country, and that is renovation and remodeling loans. I gave up a little bit to be with them. I gave up the ability to broker some of those loans that really never go anywhere, and maybe you'll do one of those a year. So I gave that up. I gave up those carrot loans that everybody comes looking for when they realize that the rates are outrageous. They don't do them. Not to say that we don't do some investor loans, private money loans, with those 6 to 9 to 10% interest rates. We have some of those, but they're good. They're no pie-in-the-sky loans, if you will. So when I first got excited about renovation and remodeling, I was watching HGTV. We had a home rented in Severn, Maryland, and my husband, who's with the government, we were stationed in California for about 3 years. And I said, I want to flip a house. This is exciting. It was 2006. Wow. Was I lucky? He said, why don't you flip our own house first? I flew back and forth across the country. I hired 3 contractors, and in 6 weeks, I was able to spend $60,000 of our money. But I was able to sell the house for over $100,000 more than I could have gotten in the middle of winter. We sold it in February, and this was in a down market. So I really believe in people who come. Someone called me this week and said that they had flipped their own property, and I so related to this person. It's what I believe we should all do at first. One of the problems with flipping is that although we're in a good market, although interest rates are going up, property values are going up, and people don't think that they can be hurt. But there is risk. There is risk involved in investing. And what surprises me most is everybody's worried about interest rate. What is the interest rate? What are the closing costs? If you raise my credit score, can I get a better rate? Now, this isn't just home buyers, this is investors alike. But there's more to that. You should be asking other questions. You should be concerned if you're a new investor. What if the housing price goes down? What if I get into a renovation and although I set aside $90,000 for this renovation, it's $140,000? There's a lot of risk. You've had risk, right, Stan? What? Holding cost. Before I did my first seminar, I got a call from a man asking me if I could help him get a hard money loan to get out of a hard money loan. So he told me a story. He had a 4-unit property down in DC, and he was living in it. But the hard money lender told him to go rent a property so he could give him a hard money loan. Because that property, once he renovated it, was going to be worth $1.8 million. And at this point, it was worth $680. So he moved. They got this hard money loan, and 12 months later, his hard money loan was due. He owed $1.4 million on the hard money loan at this point. His house was worth $1.25 million. He had been living on the income from renting out the other properties. He was too old to go back to work. So his life had taken a really bad turn. On the other hand, you can go to some of the investor seminars and they're going to tell you about the good things. It's so exciting to buy a property for $800,000 and turn around and sell it 6 months later for $1.8 million, isn't it? It's just not so great if you haven't calculated that it might not go just right. And that's just what I want to balance it. This is an exciting industry, but go in with your eyes wide open. There's nothing wrong with going into a joint venture with someone that you know, someone who is like-minded, who wants to sell the property the same time that you do. But too often I hear of people who go into joint ventures, they meet people at seminars like this, and they go into joint ventures, and the next thing they know, they have 6, 7, 8 properties, and they want to retire, so they'd like to sell some of their properties, but they can't, because they're with younger investors who are waiting until their kids go to college before. These people are going to be dead. Well, probably. Might be 100. They not be dead. I'm sorry, that was rude. But the point is, if you're going to go into business with someone, you really ought to know who they are. And they ought to have the same goals that you have. Some of you here this evening are investors who are really first-time home buyers. And that's really exciting because you can get into properties really inexpensively. Some of you are home buyers who just want to buy a property with a little bit of equity. And we can teach you how to do that this evening. When you open your book up to about page 3, you're going to see a rent versus buy sheet that we just stuck in. One of the things I do as a lender is I help people to see if it is a good option for them to buy rather than rent. We talk to them about their long-term goals. We talk to them about college, their kids' college. So buying a property just because you're saving a couple $100 a month may not fit for you. Maybe you need to wait a year. We just want you to know that we're going to give you an honest answer. So in some of the calculations in and you can see inside of your booklet that we talked to you about after-tax, and this thing's a little bigger than the one I have in my office. We talked to you about your after-tax payment. And you can see on this particular scenario that his payment is $2,000 a month, but his after-tax payment is only $1,625. So there is an advantage still, tax-wise, to purchasing a property. Go on to the next one. So when I speak to investors, and I speak to a lot of investors, and they're always asking me those same questions. What is the interest rate? How much are the closing costs? And that isn't bad. But what are you trying to accomplish? So we like to talk to investors about the ability maybe to rent a property rather than flip it. And I'll tell you why. The ability to flip properties right now, the ability to buy a property and turn it over and sell it is tighter and tighter every week that goes by. So in one of our seminars, we had a man who developed a calculator to help investors like yourself. What was his name? Ultimate Rehab Calculator? Yeah, Ultimate Rehab Calculator. And he stood up there, and he's a contractor. He actually does the work himself, so he's really going to be profitable. And he showed a typical scenario that he was doing that week. At the end of the day, after working a couple months on his property, he was going to make $20,000. But he was also going to work 2 months. So if my contractor's looking at me like, what are you doing to me? Every now and then, somebody runs across the property that they're going to be able to put $50,000 in or $100,000 in, and they're going to make $200,000, $300,000. That still happens. But for the most part, it's a very competitive market. We're out there. One of my favorite clients, Wesley, is back there. I think he's brilliant. He's taught me more. How many years have you been doing this? What, 12?
17.
About 17. Well, and you look so young. But he must have a very supportive wife. Because they buy a property about every year or so, and he understands when he can't pay more. You know, I'm the lender. I'm on commission. His realtor, they're on commission, and we're always saying, why don't you just pay $10,000 more? Let's close this deal. Just pay $10,000. He goes, I can't do it. It's not going to be profitable when I sell it. And you know what? He's right. One of the most amazing things that he taught me was walk away. Don't fall in love with the property until you own it. Walk away. I can't tell you how many times these banks have come back and asked him, would you take it? Would you still take it for whatever you paid? Or for whatever you offered us 2 months ago that we told you was insulting? Will you still take it? And it happens. So be willing to walk away. This calculator is one of the best tools that I have for investors, and this is your internal rate of return. I'm going to read the definition of a internal rate of return. It's a metric used in capital budgeting to estimate the profitability of potential investments. The internal rate of return is a discount rate that makes the net present value of all cash flows from a particular project equal to zero. This is what it tells my borrowers. When you look at one of my products like the Home Style and you're an investor and you're getting a 5% interest rate and you're putting 15 to 20% down, you can put 15, but we're going to charge you points, so you might as well put 20% down if you can. An experienced investor right now should be getting about a 10% interest rate. So they tell me. They might all be cheating on me a little bit by a point or two. A new investor is going to be getting about a 12% rate. About 6 months ago, the investors that I saw were giving 12 to 15% rates. If they knew you, they liked you, 20% down, 2% origination fee, and a 12% rate. They didn't know you, if you didn't have experience, it was 30% down, a 4 to 6% origination fee. But things have gotten a little better. Rates have gotten better, private money's gotten better, but I imagine it's going to be going back up pretty soon. So in this particular property, the person bought the property for $250,000. They put $50,000 in renovation money. In the traditional home style loan, you'll see 1.35%. I just put all of the underwriting fees and all that other garbage into the 1.35. For the experienced investor, they're paying 2 points. For the new investor, you're paying 4 points. At the end of 6 months, the net proceeds is about $2,000 to $3,000 more than your cash to close. Not really a great deal. So a lot of I think the biggest competition, and I imagine this is the same for you all, the biggest competition we see are the $250,000 and below properties. Those are the tough ones. One of the things that our renovation and remodeling loan is going to do for you, it's going to give you the ability to go up to a $675,000 property with only 15% down and a 5% rate. Your annual rate of your internal rate of return isn't great. You want to go to the next? This next slide shows you if you hold it for 12 months. And like Stan said a few minutes ago, it was the carrying cost of that 6 months, right, Stan? So holding this for 12 months, you have the opportunity to rent the property, and your IRR is going to be much better. You're talking, again, with the home style loan, with that traditional loan that we're offering, you're talking about a 16.5% return rather than losing money. But here's where it gets really good. Let's say that your first investment property is your own home. Whether that's a 1, 2, 3, or 4 unit property, you're going to have the ability. You're going to have the ability to put 3.5% to 5% down. It is your property. You're going to be living in it. Whoops. Nope. You know what? I didn't put it up on the slide, but I did give you a third. So if you're beginning as your primary residence, you'll have and you're only putting 5% down or 3.5% down, you're talking about a 44 to 53% IRR. Now that's an investment. I know there's a financial planner here. I know you can't compete with that. I find that one of the most important things of being an investor is building your team. You need a real estate agent who understands what just a roundabout average of what these repairs and renovations are going to cost you. You need a real estate agent who's a good negotiator. The most heartbreaking thing I've seen is when realtors are pushing people to buy things when they should be negotiating on their behalf. So make them toughen up, make them represent you. Of course you need an experienced lender. You need a real estate attorney that can guide you. How do you hold title? You need somebody like Steve Rubin. You need somebody like Chris Storage. who knows how to teach investors how to own title, whether it's LLC or trust, or what are the long-term benefits or problems. You need a good renovation consultant. You need a contractor. You need somebody like Rob, who's a 203K specialist or a home style conversion specialist. These are my team. These are the people that I value. I work with a lot of contractors. We have to work with whatever title company the borrower wants us to work with. But when I have my preference, I use people that I trust. And you should be building that team. That is going to be the most important thing that you can do. Hey, Steve, can we introduce you for a couple minutes?
Hi guys, my name is Steve Rubin. I know I've met a few of you before. Wesley. We love him. I'll tell you why, man. He just plays it by the book. I've done a lot of deals for him, but more importantly, I've been to his properties, and I will tell you something before we get on to how the transactions work. There is serious competition for all of you. You're competing against a bunch of other people just like you. They're out there flipping properties too. If I go to a community, and I'll name one in the area, Montgomery Village, and I look for properties that people are going to fix and flip, and I'm a retail buyer, I'm going to find a couple of them. And I'm going to pick the one that was done right. Well, Wesley's going to do it right. You're going to buy the one that was done right. So I don't want you to think it's not limited to your skill. You have to be good at what you do. You have to get the right loan, you have to get the right contractor, but you've got competition out there. You're going to get the stainless steel appliances and the good floors, and they better be level, because our consumers these days are noticing all of that. And they may not say anything to you, but when they walk out the door, they've checked it out, okay? And they know what they're looking at. But let me shift gears for a second. For people like you, and owning a title company for many years, the difference is that you're buying distressed properties, and I don't mean that the property itself is physically distressed. I mean that the title history is distressed. It's been through a foreclosure, maybe a short sale, maybe an REO. What are those things? Well, first of all of them consist of the fact that somebody owned the property that couldn't afford it. And while they owned it, they got judgments and liens and bankruptcies and foreclosures and all kinds of horrific things happened to them, all of which affected the title of the property. My job when I transfer a property is to insure it. I am a title insurance agent. I have to be able to transfer the property to you and guarantee to Kathy's lender in an insurance policy, no different than your State Farm policy, that I guarantee that as the owner of the property and the lender of the property, there are no liens or judgments, foreclosures, ex-wives, nothing. It's done. Well, to do that for you is not as easy as to do it as new home construction and houses that have been around for only one or two transactions. You guys are buying properties that have been through stories that can make books out of. People and feuds. I mean, you know, I sit at tables and I hear people yell at each other, and I'm over. I think I should be writing the book the whole time. And the truth is that all of that is a problem. All of that hurts my ability to insure it. I have to be really experienced in learning how to research everything that happened in the chain of title. One transfer to another, to another, to another. One mortgage we paid off, one mortgage we paid off. What happened in the foreclosure, who got judgments, were they paid off? You're buying those properties. You're not buying the Pulte home that was built 8 years ago, right? You're not buying, that's not what you're here to do. You're buying the row houses and the things that you're gonna make money on because there's a history that's messed up. You're gonna gut it, you're gonna fix it and flip it, but I gotta deal with the history, and so do you. So when you go under contract to buy one of these properties and you give it to me, and you call me up 3 weeks later and you're like, what's going on? I'm like, oh my God, it's a hornet's nest of crap. I gotta find this release, I gotta find this attorney, I gotta find this ex-wife, I don't know where the death certificate is, I don't know if this person's even dead, and who died first. because that's what I do every day, okay? And it's important, I have a lot of investor clients that do flips. And it's always important for me when I meet them and I start working them, that I say to them, this is what I'm doing. This is what's going on every day. I need you to understand it. It's not like when you bought your first home with your husband. It's nothing like that. So, it's important for you guys to get educated in this stuff as we go, and I'm all about calling up and saying, hey, we got the title back, we got this, we got that, I'm working on it, don't worry, but I just want you to know where I am. And I want you to understand that that's the world you're venturing into, if you haven't already learned that. I know you have. It's just the way it is. I remember one day I called Kathy up and I said, this is the worst title I have ever seen in my life. So, like, you know what her answer was? You called me a month ago and said that to me about another property, Steve. Well, I probably did. But anyways, she just put some real letters. Anyways, it's important for you guys to know that. Now, another thing that you're going to learn is how to vest the property, and I get questions about this all the time. I know most of you guys are pretty sophisticated when it comes to this information, but let's just go through it really quick because there's two categories that are important. You know, you can buy a property as a sole owner, and that's fine. If you're investing in it yourself and you're doing that, that's okay. A lot of people that choose to do that talk about whether they want it to be in an LLC or a trust, and Chris is going to talk to you about that. But when you talk about that, you're talking about two things. You're talking to an attorney that understands trusts and LLCs and liability, and which is good and which is bad. But you also have to understand what your lender is willing to do. You might find that Chris will say, well, a trust is fine for what you want to do, or you can do an LLC. You have to go back to your lender and say, well, Chris said this, and under this transaction, Kathy might say, no, we have to go at it a certain way. Let's pick the LLC or the trust. You have to work with both, okay? It's really important. Now with me, if you're gonna buy a property with somebody, the first question I always get is, well, I'm buying you with my husband or my wife. What do I do? Well, you're getting it tenants by the entirety with what's called right of survivorship, which is great because that means that as tenants by the entirety, if there's a judgment against one of you, it just remains a judgment. It does not attach as a lien. A lien is bad. A judgment is just a debt. A lien means it literally attaches to your property. You buy a property, husband and wife, and you get a mortgage. We call that a purchase money mortgage. You and your wife sign a lease for a carpet store because you decided you're going to get rich selling carpet. And you both sign the same lease commitment. Never do this. Any attorney will tell you not to do this, and I've seen this. Because what happened when the store didn't go well? They got a judgment against both of you. And because that judgment was against both of you, it is now a lien. It is the only way you can get a lien on a tenants by the entirety is if it's literally against both owners. So you never want to do that. So you do the reverse. If you own a property tenants by the entirety and you want to go into business, one of you signs commitments, not the other. The tenants by the entirety with, tenants by the entirety with right of survivorship, the latter part refers to what happens when someone dies. When someone dies, the property immediately vests in the other person. And this is a wonderful thing because the last thing you want to do is worry about how half of the interest in the property suddenly has to go through probate, depending on the state, suddenly has to go through heirs and wills and fights. The best thing is simply to have tenants by the entirety, right of survivorship, and then when someone dies, it just becomes the other person's property. The next level is joint tenants. Joint tenants is where two people that are not married, and I usually say this is like two brothers, me and my brother actually bought a property. We did joint tenants, and we knew with right of survivorship, if one of us passed away, we wanted to become the other person's property. Okay, neither of us was married at the time. So that's a good example, but if you and I, Robert, say, hey man, we just met at this thing and we know we're good guys, right? We're gonna buy this townhouse, we're gonna gut it and flip it. How do we wanna own it? Well, we probably wanna go tenants in common, which is the lowest level of protection. And you say, well, why would you do that? Well, if it turns out that I pass away as we're redoing it, I really don't want you getting my interest. I don't really know you that well. I want it to go to my heirs, which is great. That's the upside. The downside is that if you and I own it together and I get into a car accident and I have no insurance and I get a judgment against me, it's going to attach as a lien, even though it's only against me because it's joint tenants in common, okay? We're not married. So each application is important, and the best thing to do is every time you buy a property, talk to who's doing your settlement and say, let me describe to you what we're doing, who this guy is I'm doing it with, and give me advice as to how I should vest the property, okay? I'll let Chris talk about the trusts, and I'll let Chris talk about the LLCs and bring Kathy back into that as well, okay? Anybody have any questions? All right, we're good.
You want to introduce her as one of the most
Oh.
brilliant women I know?
Well, I introduced you to Chris Sorge, didn't I?
You did introduce her.
All right, rock on. So Chris Sorge, when I got into practice where I am at this particular facility, I met Chris through as a neighbor, which was coincidentally, what I didn't know was she was working for a firm that I was doing work for already. It's a small world. So I met Chris, and she's an expert in her field, and being in a specific field is important in law these days, just like medicine. And I really want you to understand what Chris does. I don't even venture into it because trusts and estates are a very, very specific field, and when you have questions about that, you need to go to an expert, and this is one of them. So Chris, can I bring you in?
Thank you for that. That was nice words, Steve, and thank you, Kathy, for having me tonight as a guest speaker. My name is Chris Sorge. I'm an attorney at Seltzer Garbage in Bethesda, Maryland. And I've been practicing for 26 years now. When I was in law school, I took every real estate course they had in my law school. I wanted to be a real estate lawyer as much as I could do anything. I wanted to be a real estate lawyer. And I graduated in 1991. How many of you in the real estate field in 1991?
I graduated in 1991.
Right. And there were no jobs.
Yeah.
There were no real estate transactions. It was a real estate recession. And so I had the fortune of working at a boutique law firm that had clients who had large real estate holdings that were doing no transactions. So we started doing estate planning for these clients. And here I was right out of law school. I was probably the only one in my class doing estate planning because back then estate planning was not very sexy. Everybody wanted to be a litigator, corporate attorney or whatnot. So the estate planners, everybody said, why are you doing this? But now 26 years later, I feel very comfortable because my entire career, I have been doing real estate law. My clients are like a lot of you. They like to look out the window and see their financial statement. Right? They don't hold a lot of liquid assets. They hold a lot of real properties. And so my planning has involved estates of clients who, when they pass away, they don't have cash to pay estate taxes. They don't have cash to equalize among their children. So we just plan for their estates using the assets they have, which are mostly buildings, office buildings, apartment buildings, and whatnot. So in doing this planning, we do a lot of trusts, and we also use a lot of LLCs, as Kathy mentioned. And so tonight, Kathy asked me to just talk a little bit about trust basics and refer to some notes just so I can talk in an organized manner. So when you're planning a trust, there's really a couple things to keep in mind. What is the purpose of this trust? Because there's different kinds of trusts that serve different purposes. How do you create the trust? How do you administer the trust? And what's the difference between a revocable trust and an irrevocable trust? And these are the 5 questions that we ask, first of all, when we're planning for clients who want to own real estate. And so the purpose of the trust is simple. It's to manage your assets. And it's to control your assets. So the purpose of the trust is to manage and control assets. But a trust can accomplish other things for you and your family, one of which is creditor protection. If it's a specific kind of trust and it's set up properly. And then also, trust can help save state taxes. So those are the purposes of, generally, the purposes of. let me give you a quick example of why someone might want to create a trust. So, client named Joe has a daughter named Holly, and Joe wants to give $1 million to Holly. Whether he wants to give it during his lifetime or when he passes away, he just wants to give her $1 million. But Holly's a bit of a spendthrift, and if he gives Holly $1 million, Holly will go out and spend it. And Holly's husband gambles. So if Joe gives $1 million to Holly, he's worried that either she'll spend the money or her husband will gamble it away. So how does he protect it? He creates a trust for Holly. So he puts $1 million in trust for Holly's benefit. So there, we have a trust. We have a creator of the trust, who's Joe. We have a beneficiary of the trust, who's Holly. And the trustee is the third person. So we'll say Kathy's going to be the trustee. So, in order to have a trust, you need an agreement. It didn't used to be that way. You used to be able to create what's called an oral trust, where I would say, Kathy, I want to create a trust where you manage this money for me. She went in, and we have a trust. She'd say yes, I'd give her $1, and we had an oral trust. However, for real estate purposes, you have to have a written trust agreement. Your lender wants to read your trust agreement. Your title agent wants to read your trust agreement. So for any real estate investor, you have to have a written trust agreement. And the written trust agreement can be short as a page or two, or it can be, 70, 80 pages long, depending upon what it is you need. But the three basics for any trust are the creator of the trust, sometimes we call the creator the grantor, the beneficiary of the trust, and then the trustee. So let's talk a little bit about the difference between a revocable trust and an irrevocable trust. An irrevocable trust is a trust that you create, you put assets in it, and you can't take them back. So we usually use irrevocable trust for gifts. Sometimes we use irrevocable trust for creditor protection. So if you have created trust in certain states, like Delaware is one, Alaska is one, South Dakota is one, and you put your assets in this trust in those states, you can be a beneficiary of that trust, and you can have protection from your own creditors. Those trusts have to be irrevocable, meaning you can't take the property back. Those trusts also mean you can't amend them or change them from time to time. So if you're going to get that creditor protection, your trust needs to be irrevocable, and it needs to be organized under a certain state. Revocable or revocable trusts are the most common trusts that you see, and that's the kind of trust where the creator of the trust is also the beneficiary of the trust and also the trustee of the trust. So with a revocable trust, you wear three hats. You're the grantor, the beneficiary, and the trustee. And it's essentially an alter ego of yours during your lifetime. So you can put the property in the trust, you can name it anything you want, and the trust owns the property. And when you pass away, your trust agreement tells us where your assets go. Also, if you were to become incapacitated during your lifetime, the trust agreement tells us how we manage the property for your benefit during your lifetime. So you're the sole beneficiary as long as you're alive, and when you pass away, the trust acts like a will, and it tells us where your assets go. One of the reasons why a revocable trust is probably relevant to tonight's class is because lenders like revocable trusts. They know who they're lending to, it's all ego of yours, whereas with an irrevocable trust, you have to have certain lenders who will agree to lend to those types of trusts. So most trusts that we do for investment purposes, people starting out, are going to be revocable trusts. It's possible later on you can convert it to an irrevocable trust. You can watch two or into our reasons too, but for purposes of acquiring a property that's subject to a mortgage, you're probably looking at a revocable trust. You can change the revocable trust anytime you want. You can just do an amendment. You can revoke it and take your property out and put it back in your own name. You can sell your property from the trust. So you would wear your trustee's hat and sign that contract to sell your property. So you could do with a revocable trust anything you can do on your own. So they're very, very popular trusts. LLCs. An LLC is a limited liability company. And it's kind of a cross between a corporation and a partnership in that it's what we call for income tax purposes, a pass-through entity. So the income that the property generates is passed through to the owners and reported on the owner's income tax return. It does not pay two levels of income tax. And LLCs are another way you can own property. The benefit of the LLC is that you get more creditor protection than you would from a revocable trust. The LLC is not your alter ego. You own the interest in the LLC, and the LLC owns the property. So if you invest in a property and someone on the property slips and falls, and they sue the owner of that property, they're not suing you, they're suing the LLC, because the LLC owns the property, and you happen to own the LLC. So your liability is limited to whatever assets are in that property. And it's a very beneficial way to own property, except that a lot of lenders don't like lenders. So again, you have to talk to Kathy about your options. If you want to own your property in LLC, you have to find a lender that would be agreeable to loaning to an LLC. That's the basics, okay?
So I have a question. So doesn't the trust give you protection as well? If you had a specific trust for a property?
That's an excellent question, and the question was, does a trust give you protection in and of itself? And the answer is, it depends. So it's an easy answer. So I spent more time talking about revocable trusts, because they're the most common types of trusts. And a revocable trust, being an alter ego of you, does not give you creditor protection. So if you have your assets in a revocable trust and you're in a car accident and you get sued by the driver of the other car, any assets that are in your revocable trust can be reached the same as if they're in your own name. So the revocable trust does not give you that creditor protection.
What about the revocable trusts that are property specific?
No. Nope. If it's revocable, meaning you can revoke it anytime, you can amend it, and you can change it, you do not get that creditor protection. The one creditor you may get protection from is your spouse. So if your assets are in a revocable trust and you don't have a premarital agreement, you may have some creditor protection from your spouse by virtue of having kept your assets separate. And again, if you don't include your spouse in your estate plan and your assets are in a revocable trust, you've got that creditor protection. But if you want creditor protection for, if you say you buy an investment property and you put it in a trust and you're worried about somebody suing the owners of that property, it needs to be either an irrevocable trust or in an LLC.
One of the practical things that I see at the closing table when we're doing a transaction that you need to understand is that whether we're doing an LLC or a trust, you're going to sign papers that say that you're guaranteeing this mortgage on behalf of the LLC or trust, and then you're going to sign another document that says, I guarantee it personally. Kathy's going to explain to you how you qualify. Is it just the income of the LLC? Trust usually don't have income. They're going to look back to the individual. So keep in mind, you're going to guarantee the loan personally either way we go, okay? It's important to know.
I'm so glad she clarified that, because I have investors who want to purchase in the name of an LLC. So here's our issue when you're purchasing in the name of an LLC. Fannie Mae, Freddie Mac, Ginnie Mae, they will not allow you to buy in the name of an LLC. They will only allow you to buy in the name of a trust or in your individual name or some of the ways that Steve discussed.
Right.
So here's my issue as a lender. If you come to me and you want to buy in an LLC, I can't be a Fannie Mae, Freddie Mac, or Ginnie Mae backed mortgage. Fannie Mae, Freddie Mac, they won't buy the mortgage from us. So those 5% interest rates that, were 4% 2 weeks ago, those interest rates, those aren't available in the name of an LLC. We're talking about private money. And private money is a little bit different than that hard money, 10, 12, 15% we were talking about. Private money is more like that 6 to 9% interest rate, depending upon your credit and your experience. So I see a deer in the headlight. Look, does anybody have any questions? We're getting this, right? Okay. Is this boring? Okay, so it's really important. You're an investor and you want to buy a property and you want to protect yourself. Chris made it very clear today, and this is something that I didn't understand, because I, as a lender, am always saying, please, put it in a trust, don't put it in an LLC. Now, I know that if you were her client and you were sitting in the privacy of her office, well, I don't know this, I'm assuming, she might be able to teach you, depending upon the state that you're in, how you can buy in the name of that trust, so I can give you that great interest rate, and then she can flip you to an LLC and you don't pay transfer taxes. Is your face turning red? Is that okay for me to say that? So it's possible. So this is what I try to get my borrowers to do and have private conversations with their attorney. Any questions? Want to talk about, oh, yeah.
If you do transfer, so you bought it and transferred, as a lender, do they call that too? Can you have ways to call that too sometimes?
Okay, so, oh, there you go. So this is sticky. I am on camera, right? So I have heard, I would never advise anyone to do this. No. If you buy, and he's laughing, if you buy in your name, and you're buying with a Fannie Mae loan, with one of those mortgage-backed securities, lower interest rate loans, and you wait a sufficient amount of time for that lender to bundle their loan package and sell it to Fannie Mae, then you would probably not have any issue. But have a real intense conversation with your lender and make sure they understand how, you and they understand how long it's going to be before you put that in the name of an LLC. So the last time, and this is serious, I jest, but this is serious. So the last time I had a borrower who said, I'm just not going to buy a $500,000 property with a 7% interest rate. This 4% rate is all I'm going to pay. So I'm going to go ahead and I'm going to bite the bullet and I'm going to buy it in my name. And then you tell me how long before you can sell this sell this to Fannie Mae, and I can put it in the name of an LLC. So we figured that out for her. But if you turn around the next day and you put it in the name of an LLC, or at the closing date 1 hour later, and that lender goes to sell it to Fannie Mae, and Fannie Mae says, we're not buying that, then they're going to call your loan. Does that answer your question? So, I'm going to talk a little bit about the benefits of renovation, because this is what I love. There is so much immediate equity. You didn't know that, right? So I love the renovation loans because they are immediate equity. Because who doesn't want to buy a property for $200,000, $300,000, $400,000, $500,000, $600,000? There's one up here in Gaithersburg that's available for about $600,000 and needs about $100,000 worth of work. And they say, this agent tells me, is going to be worth $800,000 or $900,000. But there's some real deals out there. There are some real deals. I hate to make everything that I tell you as a lender about caution, caution, caution. Because as long as you're being cautious, you can keep your eyes open for those great deals, and they are out there. Let's go to the next one. So, you all probably know this already, but if you don't, there's nothing wrong with you looking at what your biggest returns are in curb appeal, increasing space, minor kitchen remodels, energy efficient renovations. Those are great. Those are great, especially if you're the homeowner. But the last thing you want is, if you're renovating a house, is to have someone come in and look and you've got this beautiful granite kitchen and the roof is bad. So, take care of those basics. The renovation lending options that I'm talking to you about this evening are the conventional options, the repair escrows if it's under $5,000. If you go out to buy a house and you really don't want to buy a renovation loan, but there's just some work that has to be done in order for Fannie Mae or the FHA appraiser to approve this. If there's holes in the wall, little things, maybe a cracked sliding glass door, things that they consider a problem. As long as it isn't a safety issue, up to $5,000 you can escrow the money. You don't need to get a renovation loan. Renovation loans are a minimum of $5,000, and depending upon the type of loan, there really is no limit. The home style loan, one of my favorite loans, is for owner-occupied or investors. As an owner-occupied property, you can buy a 1 to 4 unit property and do it as a renovation. But as an investor, you could only do 1 unit properties at this point. So, single-family residences, condos, townhomes, those type of things, single-family, 1 unit. The difference between this home-style loan and the FHA loan is we're only going to give you the renovation funds up to 50% of the after-appraised value. So to make it easy, if you're buying a home for $300,000, we're going to give you $150,000 in renovation money. As compared to the FHA, where we don't have a limit on the renovation money. It's a little bit more exciting. The renovation money on an FHA loan is, there's 2 versions. There's the FHA Limited, the 203K Limited, which is up to $35,000, and you don't need a consultant for that. You only need your contractor. Then there's the full 203K. And so you can buy a house for $100,000 and put $400,000 worth of renovation in it. We don't mind if it's an FHA loan, as long as it's going to have the after repaired value, which goes up to 110%. Have I gone too far? Did I miss it? No. Okay. The nice thing about FHA loans is you've got 6 months for repairs on the home style loan. You've got up to 9 months for repairs. Some lenders will give you 12 months. We don't. That's our bad thing that we don't do. We don't give you 12 months. We give you 9 months on the home style. So these are the differences between the two. That didn't come up in red. Okay, so 6 months to complete the work on FHA, 9 months to complete it on the home style. On the home style, there's a little bit difference in down payment when you're getting into these multi-unit properties. The exciting thing about the FHA loan is I've got so many borrowers down in DC buying 4-unit investment properties. They're qualifying they're qualifying to purchase this property with the future income of the other 3 units. So another member of my team. This is Rob is a contractor. He's a 203K specialist. You do need you need to have a contractor that understands how to fill out the forms. I will tell you this, that Rob and I did work when I was at another lender, and there were a lot more forms to fill out. Now we have 6 forms. One of the reasons that I moved to this lender is because they are incredible at renovation and remodeling. And they're so easy for the contractor. So I was actually, many of the contractors that I work with, Rob and some of the contractors I work with in DC, have told me that please move to Michigan Mutual. So for many reasons I did that. And Rob's going to tell you a little bit how this process works.
Great. Thank you. First of all, thanks a lot for having me here, Kathy. I appreciate it. And one of the things I'll say first and foremost is it's critical to have a good lender, a lender that understands the process, and certainly a lender that has the wherewithal to get the loan moving through the process quickly. A lot of times folks are sometimes concerned about 2 or 3K loans and that perhaps they think it's going to be a little bit more time intensive and a lot more hoops to jump through. But the fact is they can be as simple and straightforward as a regular loan, provided you're working with a lender that understands the process well. In terms of the role I play in this is that, and what is distinct from a typical loan is that a contractor is involved, obviously. And as part of the process, the bank wants to understand what repairs are going to be done so they understand what impact that has on the after repaired value. Because they're going to lend you money not just based on the value of the house now, but when it's done and completed and ready for occupancy. So in terms of the process, first and foremost, you need to get a preliminary feasibility analysis. The goal here is to understand what the repair costs might be and what the after repaired value might be as well. Once you have that, you execute the sales contract. And then the consultant, the 203K consultant in this case, will prepare a feasibility study. It's a bit more detailed, and what it does is, on the one hand, identify what FHA minimum property requirements are. Things like the absence of a handrail, the absence of a heating system. Certain things must take place in the house or must be there. And this feasibility study is going to highlight for you what are those minimum qualifications that must exist. Beyond that, it's really up to you. It's up to you as the investor or the homeowner to determine what things you want the house to consist of. Do you want to remodel the bathrooms? Do you want to remodel the kitchen? Do you want new carpet? Do you want to put a roof on? Those are things that if the current situation for those items isn't that it's in disrepair and triggers a minimum qualification by FHA, it's really up to you. And that's the critical thing. As an investor, you need to be thinking through what rehab changes you think are necessary to enable you to get the retail price that you're looking for if you plan on flipping it, or if you're going to be living in it, kind of what's necessary for you to enjoy the comforts of your home. After that, once you have this feasibility study and once you have the estimate from the contractor, it's then provided to the appraiser. Because as I mentioned before, the appraiser wants to assess what the after repair value is going to be, and they got to know what those repairs are that you intend to make. After that, the renovation loan is underwritten, because they then know what it's worth now, what it's going to be worth in the future. The bank makes their loan assessment based on that. The loan closes, and then the fun begins. And a lot of times I find myself in a position as a contractor of sometimes you're focused on getting the paperwork done and kind of getting things done that are required by the bank. But once the project is set up to begin, I like to spend a little time with the borrower to sort of reassess what we're really trying to accomplish, and to make sure that if the goal is to rent the property, that we're thinking about fixtures or features that are going to be ideal for a tenant, as opposed to if your goal is to live in the house, clearly you might want to have more expensive appliances, or might want to consider fixtures that are a bit more expensive. Clearly things you wouldn't do if you're renting the property. I think beyond that, I think essentially it's a matter of, I'd say as part of the process, it's really important to be as specific as you can with the contractor. The more general the project plan, the greater the likelihood of there being issues as you get into it. And so for me, when I do my estimates, they are super detailed. I'm really clear about how much money we've allowed for kitchen cabinets or for carpeting. And I try also to help my clients understand if the house is really in disrepair and you're kind of opening up walls and moving walls and that sort of thing, and in their older houses, just kind of keep in mind that there are issues lurking behind those walls oftentimes, and you have to be mindful of that and kind of be willing to be flexible and adjust along the way as you encounter those issues. So, any questions about the rehab process? Yes.
Rob, what is the time frame from steps 1 through 6?
In terms of 1 through 6, I think it
30
depends.
days with our company. So, could I?
Yeah, please do.
Okay. You don't have to leave. So, the renovation loans with a lot of lenders are a carrot. And I've often heard loan officers say, they get in to see a realtor, they get in to see a borrower because they do renovation loans, and they pray that they never get one. Because they don't know, they don't know how to do it, their company doesn't know how to do it, they're brokering it, they're selling it to someone else, and they're gonna figure it out as they go along. The loan processors hate them, the underwriters hate them, they just don't do it. But this is what we do. So oftentimes I'll get someone coming to me who's a realtor, has heard me speak, and they'll say, we've been 3 to 4 months trying to get this renovation loan closed. And it's really a matter of just, okay, do we have these 6 documents? Do we have the after appraised value? Oh, you never called a consultant? Okay, let's take the contractor's bid and give it to the consultant. We should have done it the other way around. The consultant should have come in before the contractor, but it goes either way. And then we close the loan. We can close them in as quickly as 30 days. I really like a month, ladies and gentlemen. So I like a month because you know what? The minute that you get that ratified contract, you've got to be able to move. You've got to call your contractor, you've got to call your consultant. I have a woman who's getting ready, there's a couple 4 units coming on the market in DC. She's already called her consultant to make an appointment because she knows she's going to bid heavy. She knows she wants another 4-unit property, and she wants her consultant to be able to come in and give her a bid, give her a scope of work, excuse me, within a week. So if that happens, we'll be able to close her loan in 30 days. And so that isn't an issue for us. Most brokers, they do need like a minimum of 45 to 60 days. Some companies, they use a company called Land Gorilla out in, I think it's in Utah or California, Land Gorilla, I don't remember. But they're out on the West Coast, and they kind of go over. They make sure that lenders who are brokering these loans know and get every document that they need so they don't have to buy this loan back. But they take a long, long time. Their appraisals take 6 weeks. On the other side, my first 4-unit renovation loan with this company, it took me 24 hours to get the approval. It took me a week to get the appraisal back. Boop. That was it. So we're fast. We're fast. Yes, ma'am.
Is the fee for the consultant feasibility analysis, is that a line item on the closing documents to have that done?
Yes, so your consultant is anywhere from typically $600 to $1,000, depending upon the amount of the loan. Most of my consultants, I do some pretty big renovation loans, so most of my consultants are around that $700 or $800. The only reason you can go over $1,000 is $25 per unit. So if I'm doing a 4-unit and I'm doing over a $100,000 reno, it's going to be $1,100 for the consultant. So just so you understand that the consultant's fees, the permit fees, the additional, we only charge one title fee, $150. Some people charge like $500 or $600, several title fees. But all of those fees are rolled into the loan. So we do put them on the CD, and then I usually do this paperwork in my office because it confuses a lot of people, and I just get a glass of wine. No, I'm joking. I really like to do these loans, so I sit down and I do them, and I can tell you day one how much money you're going to roll into the loan and how much money you're going to come to the table with. Whereas in my past life, when I had someone else controlling it, we were 3 days before closing and we couldn't tell people how much they had to bring to the table. But it doesn't happen with me. I know it still happens out there. So all those fees rolled into the loan.
What's your home, what's your home pay?
We want everybody.
What's your loan fee? You down payment assistance, the Maryland program?
Yeah, so it used to be that the Maryland Mortgage Program and Home Path and such, they would piggyback with the 203Ks. They decided that they couldn't. And what would happen is they didn't know how to underwrite it, and they didn't understand it, so the loan would just sit there at CDA, Maryland Mortgage Program. So no, they don't allow it any longer, so we don't allow it. But with the FHA loan, 3.5% down, and here's the exciting thing about this loan. I'm going to bore you all with a little more of my math here. We'll lend you up to 110% of the after appraised value. So let's say that you buy a house for $100,000, including all the renovations. You're putting your 3.5% down. The after appraised value ends up being 140. So your loan to value is really below 80%. It's an FHA loan, right? Your mortgage insurance is cancelable. People don't realize that. No, mortgage insurance with FHA, it doesn't cancel anymore, does it? Right? But as long as you put over 10% down, the mortgage insurance is cancelable. And so the 203K is a way around that. That's our loophole. It's an exciting loophole. You want to talk anymore?
I
You're
think,
done?
unless there are other questions, yeah, that's it. Thanks a lot for your time, guys.
Where do you find this vendor, the department? Are they certified contractor?
So Rob,
I mean, are they certified, dictated by the vendors, or how do you go find the contractor?
I'll give you my card, that's probably the easiest way, right? But there's also, there is a website, 203kcontractors.com, and it lists individuals who, I'm on that website as well, by the way, but it lists individuals who have been through the training program, who understand the 203K program, the paperwork requirements and that.
I've only had 2 deals go south. And that was because we were waiting on the contractor to complete their paperwork and get us their licensing. If you have a contractor, as long as it isn't a family member, I'm sorry, I'm gonna steal your thunder there. But as long as that contractor isn't a family member, there's no identity of interest between you. And they have a license and they can give us 3 references of like jobs in the last 90 days, and they can do the paperwork, you can use them. He's got a girl that just does his paperwork. That's why we like him, because when he's out actually doing the work, like other contractors, they're actually out in the field, he's got somebody sitting in the office that does the paperwork. That's a big plus for us. Having that contractor move is a big, big plus. But you don't have to be a certified contractor. But it really helps a lot. You want to close in 30 days or you want to close in 60 days? It really is about the contractor being the best friend.
One more question. Before the business you have to put down, was that, do you source the funds on that, or does it one time freezing?
I'm going to be seasoning them for 60 days.
Okay.
So FHA rules are that if there's what, 25 marks, here's my processor, by Mark, is 25% of the value of the property that doesn't have to be seasoned. Is that what it is? There's all kinds of formulas. But there's, that's conventional, 25% of, no, 50% of your income, FHA is 25%. We go by straight FHA guidelines. So, yeah, can there be a few dollars that you haven't sourced? You have to, if you want to explain them. Sure. You can get a gift. Brother, father, stepmother, stepmom, step-uncle. Anybody but a cousin. We don't source the relatives stuff. We just look at their income. This was so exciting. I want to thank you all for coming here this evening. If anyone would like to make an appointment to get, let's go. I didn't even finish. No, let's go to the next one. We did this. Okay. So, something that we do differently than everyone else. When you speak to an agent and they say, are you pre-qualified, is because realtors work on what? They bill like attorneys, right? They work on commission. So if your realtor doesn't want to take you out looking at 200 houses over a 6-month period until you're pre-approved, don't hate them. That's kind of a normal thing. They want to be able to put gas in their car and food on their table like the rest of us. We can pre-qualify you. The law says that if I pull your credit and you tell me how much you make, and you tell me how much your assets are, I have to give you a pre-qualification letter. And I will give you a letter that's as good as the paper it's written on. If you want to be pre-approved, I'm going to look at some documents. But in the same light, a pre-approval listing agents are going to call me and say, come on, Kathy, what did you really look at? And we do something a little bit better. We give you a lender commitment. We take those documents that we normally use for pre-qual or pre-approval, and we have them underwritten within 1 day, and we give you a written loan commitment. So when you're out there and you are bidding on a house, and there's 9 other people bidding on that house, you've got a loan commitment. Can't tell you how many times a bank rep has called me and said, hey, on this short sale, we are not going to accept their contract without a lender commitment. How long is it going to take? Really nice to say. We already have it. Didn't the realtor show it to you? So that's the big plus of this company. If you would like to get a lender commitment, if you would like to know exactly where you stand, if you'd like to know exactly where you stand, give me a call. This takes a few documents, right, James? A few documents. James is looking at a couple more units down in DC. He's gonna do well. Thank you all. If you would like to get a lender commitment, please give me a call. Mai Lu, one of our loan officers, is there. She can help you as well. Thank you all for coming. Please stay around, enjoy. We're taking care of a couple glasses of wine, but if you'd like something else, feel free. Just mingle, pass business cards, have a great time tonight. Ready?